You want to know what are the best stocks to buy now and what is going on with the market. Now, September is historically a weak month. Let's talk a bit about that and 7 stocks that I'm buying now. So as you probably know, we had a sharp sell-off yesterday, especially in tech stocks. Here are 9 reasons that stocks tanked to start the month of September. Now, September traditionally is a weaker month. I'll talk about that in a second. But recent economic data wasn't great. Of course, we know it's a race for the Fed to cut rates, that soft landing versus hard landing. Liquidity isn't great with NASDAQ 100 futures essentially at year-to-date lows. You also have paper paranoia, commodity trading advisors, buybacks slowing, yen trade, the carry trade, investors taking profits on chip stocks and AI movers. Nvidia sold off hard yesterday, 10%, and was in bear market territory, so 23% decline from intraday high set on June 20th. And it did break through the 50 and the 100-day moving average. Now, of course, Nvidia in early August sold down to $90 a share. It was $90.69 here and popped from $90 a share all the way up to over $130 a share. And oftentimes you see a 50% retracement. So when you see a sharp pop, you take that bottom to the top, you add those two numbers together, divide by 2, 50% retracement. So you're kind of in that range here, right below that 100-day moving average. I've been long on Nvidia since 2017, under $4 cost basis. I like this stock, especially if it gets under $100 a share, even though it is up, 3,000% over the past 5 years. Fundamentally, this company is firing on all cylinders. I do think it'll consolidate and eventually get to $150 plus per share, if not later this year, early next year. And of course, that's market dependent. If the whole market goes bearish, well, all bets are off. So obviously with Nvidia being a top performer the last couple of years, extreme volatility, a lot of profit taking, but what are some other reasons that the stock has sold off from recent highs? So some different reasons for that: profit taking, negative seasonality, reports that OpenAI developing new in-house chips. Nvidia also received a subpoena from the Department of Justice. This is an ongoing antitrust probe. Nvidia told Seeking Alpha last month that it competes based on decades of investment and innovation, adhering to all laws, making Nvidia openly available in every cloud and on-prem for every enterprise, and ensuring that customers can choose whatever solution is best for them. Here's the deal, guys. Nvidia owns about 80% of the AI market when you look at GPUs. And I've said this before, it's my opinion, but we want, as capitalists, we want companies like this, like Nvidia, to do well, but not too well. We don't want monopolies. Here's the thing. Nvidia just went out and they kicked everybody's butts, and now they're, antitrust is coming after them with the subpoena. I personally don't think much will come from it, but of course it will impact the sentiment of the stock. Now, this could be a little bit controversial, but this is the primary reason. There are a lot of reasons, but I think this was the coup de grace, and this is what took futures down on Monday. Of course, Monday the market was closed, and Tuesday we had the big sell-off. Russia signals its official stance on using nuclear weapons. Now, I'm not going to go much into this, but I do think this impacted the market yesterday. So September, it's the only calendar month to average a negative return over the past 98 years. However, over the last century, the S&P 500 has been positive in September more than it's been negative. So that's important. And equities have tended to perform better in the Septembers leading up to presidential elections. Now, we had this sharp sell-off in August, and I think the market looked at that as like, hey, maybe we're getting it out of our system before September. So if you look at the NASDAQ 100, the QQQ, this was at $503 back in July, sold off hard all the way down past the 200-day moving average on this trend line to 423, and then a monster bounce from 423 all the way to 485. And then it pulled back and it broke this 100-day moving average. Now we're at $462 a share. It bottomed out yesterday at around $458 a share. The support on the QQQ is $454. Now, some positives today. The bond market yield curve returned to normal from an inverted state, which of course raised recession fears. That VIX was over 22, has dropped down to about 20 now. One of the stocks I'm buying now. In fact, I bought more shares in the community portfolio this morning. Now, I do own this in both portfolios. So I have my main portfolio that's over $2 million, and I have a community portfolio that's over $100,000. So we added some Zscaler in that smaller account this morning. Had earnings last night. It sold off on the guidance. So it was a beat in the top and bottom lines. It beat by 19 cents on EPS. Revenue up 30.3% year over year, beat by 25.29 million. The reason the stock sold off, and it's down about 20% from recent highs. It's all about guidance. And this is a good snapshot to give you an idea. So beat on the top and bottom lines for this quarter, but for next quarter mixed, and then the full year guidance for 2025 is below on both. Now, if you want my 2 cents, I think that part of this is the macro uncertainty and perhaps the management just being conservative, perhaps sandbagging on that guidance, but only time will tell. Now, growth is slowing considerably, and this is an expensive stock. This is one of those SaaS names, cloud, it's recurring revenue. So we generally use the EV/NCM revenues, the rule of 40. I'm going to provide those metrics for you. So the stock is down 20%, bringing that EV/NCM revenue to 9.6x, which in my opinion is attractive as a long-term investment holding 5 or more years. The free cash flow is still above 25%, around 27%. And that rule of 40 was over 60%, has come down, but it is still over 50%, which is solid. So here's the thing, Zscaler is growing. When you look at that spectrum from spec all the way to an income stock, it's going from a hyper growth type stock to just a normal growth. It's maturing into more of a mature company. And so with that, you're going to see increased profitability. That growth is slowing. But remember with the rule of 40, you're going to use the growth, not only in the revenue, but also profit margin. So this is one of those stocks that's going to have a non-GAAP PE of 4 to 58.92, which is expensive, but remember recurring revenue. And being a software company, it does have those higher margins. So gross profit margin TTM about 78%. So I've been saying that I like this stock, $175 or less DCA, really preference below 165. And you can see today it's at $157 a share. So it's hovering right now on that S2. The S3 is quite a bit lower here, still at $139.53, which is a possibility. It doesn't have to happen. And you can see it did kind of double bottom here at about $155 a share. It bounced off this 155.97. This is that early August sell-off, all the way from 155, 156 to over $200 a share. So it's very possible that it holds this 155 level, maybe even the S2 where it's at 157, but your possibilities really are in this range from where it's at to maybe something like $135 on the extreme downside. Remember this stock back in May of 2023 was just under $85 a share. But I like Zscaler here at $157 a share, DCA as a long-term investment, 5 or more years. Up next, just added some shares of Celsius today. You can see it's down 6.4%. So we added shares of Celsius in both portfolios today. In the main, 50 shares. In the community portfolio, 7 shares. Now, gross profit margin, this is energy drinks, pretty solid at around 50%. This is TTM. And the growth has slowed down. It's still showing 43% forward revenue growth on Seeking Alpha. Valuation, the forward GAAP PE is a 35.70. So this is a profitable company. When you look at other metrics like price to sales, it is expensive at 5.7, but with that 35% growth, I believe it can grow into its valuation quickly. Now, with that said, one of the big catalysts and the reason the stock went to $100 a share is because the relationship, that distribution partnership with Pepsi. And this is from our private community in Discord. There's a Barclays conference going on right now, and this just came out. Through the first half of the year, we saw a roughly over $47 million decrease in orders associated with optimizing inventory levels. So what this is telling us is that the relationship with Pepsi is fairly new and they have to optimize their inventory levels. They're improving supply chain timing, logistics, and just being more effective and efficient all around. So if you think about it, this is very similar to the inventory issues that we saw with semiconductors and other sectors in 2022 post-pandemic. You see, Celsius recognizes the revenue when they deliver the inventory, for example, through Pepsi's distribution network, not when the energy drinks actually sell at the scanner. You essentially have a surplus of orders and it takes a while for that to flush itself out of its system. And because of that, the growth number is going to come down and nobody knows exactly to what number. So if you're paying a 35 PE ratio with 35% growth, but all of a sudden it drops to 20%, that's going to significantly impact that PE ratio. Also from the conference, out of our control, what we can control is really the retail component, making sure they're maintaining those service levels. And that has continued in Q3 of this year. We're seeing year to date roughly around $100 million to $120 million of orders being reduced from what they ordered last quarter. So we're still seeing these inventory levels being reduced. It has increased in the third quarter. That's something we can't control. So I do believe this stock could see more pressure. I'll show you some price targets on a chart in a second. This just came out yesterday and Nielsen reads that Bang, Keurig, Dr. Pepper, and Constellation brands outperform. So Bang is actually outpacing Celsius Holdings in the recent update on scanner data. Bank sales up 13.4% year over year, and Celsius only 5.9%. So something to keep in mind. Now, with that said, Celsius is still outpacing Red Bull at 2.5%, and Monster is down 2.5%. Now, Monster does own banks, so something to keep in mind there as well. Now, this stock had a double top around $100, and it's fallen off a cliff all the way down below $35 a share today. So back in March and April of 2023, Celsius traded around $27, $28 a share, ripped to 100, now all the way back down here. These orange numbers, I did a previous video on YouTube, and I shared these numbers as a possibility, 44, 40, 34. Now, these are Fibonacci pivot points, and these have updated since then. The stock is under pressure, and we do have a new S3 at 29.40. So I think there's a chance that this breaks the 30s and goes into the 20s. What could happen is you could see this come down maybe into this $28 range. It's possible, just sharing possibilities. I like the dollar cost average DCA. In other words, buy lots on the way down and fill a position over time with a focus of holding 5 or more years of long-term investment. So I added some today below 35. You could see the stock below 30. Snowflake is another stock that I've been buying. I added shares yesterday below $110. Now, in previous videos, and I've been telling you, $100 to $125 is really what the stock is worth. If you're paying more than that, you're paying a premium. I think that, if you were to really be serious and say, Eric, what is Snowflake actually worth? Honestly, it's probably somewhere between $100 and $125 right now. So if you pay $155, you're paying that premium. If you pay $185, you're paying the premium. Bruh. So on previous video, I shared these numbers with you, these possibilities, these red lines. So you've got $119. This is the January 2023 low. Obviously, it broke that. The June of 2022 low was $110.27. This recent low, just in the beginning of August, $107.93. Right now, the stock's hovering around $111 a share. But it is important to note that the Fibonacci pivot points have updated. The S2 is now 102.72, and the S3 is below $100 a share at $91.50. So it is very possible that Snowflake could break $100 per share, especially if the entire market sells off. Now, I've been telling you that most people should avoid Snowflake, but if you do buy it, consider it a spec stock, and that means you should not go very heavy on this stock. Generally with spec, if you have a $100,000 portfolio, we want $10,000, 10% in spec with at least 10 stocks. That means that each position should be a 0.5% to 1% tops of your portfolio allocation. I do like Snowflake long-term. This is a 5-year investment. Here's the number one problem with Snowflake. In my opinion, the number one issue is the stock-based compensation. This last earnings report had a 7% positive free cash flow. But if you factor in stock-based compensation, it was almost negative 35% free cash flow. The stock-based compensation also dilutes shareholders. In fact, it's averaging around a 5% compound annual growth rate. That means every year we're diluted as shareholders by 5%. If this issue is addressed, I do believe the stock could fly. It's not a cheap stock. It's expensive. It's in that cloud SaaS arena. It's not SaaS. It's not recurring revenue. This is consumption based. I've got 3 more stocks to cover. You'll notice earlier that I talked about our private community in Discord. I invite all of you to join us. I share all of my buys in real time for both portfolios, the $2 million plus portfolio and that community portfolio. Additionally, all community members, elite or higher, share their buys and sells in real time as well. And that's a channel in Discord called Investing Trade Floor. If you want to join us, there's a free 7-day trial. Not only does our elite Patreon give you access to our Discord community, but also 3 live streams per week. And those are recorded and uploaded to Patreon. You can get access to all of this 7-day free trial. Be a better investor. Check out the link in the pinned comments. See if you can figure out which stock I'm talking about here. Just reported earnings in August. Revenue, $2.75 billion. Now that's 11% year-over-year growth. Not stellar, but check out some of these other metrics, including free cash flow, $1 billion. So they generated $1.1 billion of net cash provided by operating activities and $1 billion of free cash flow just in Q2. They're trailing 12 months free cash flow, $4.3 billion, representing a TTM free cash flow margin of 41%. 10%. Any guesses? Airbnb, which is trading below $115 a share. What's impressive about this, the profitability grade on Seeking Alpha at A+. Gross profit margin TTM, 82.59%. That's higher than most software companies with recurring revenue. It's also bringing in $701,000 net income per employee TTM. And the growth isn't stellar. You saw 11%. Forward growth here on Seeking Alpha, 13%. Still solid growth for the valuation as a long-term investment. That valuation, the gap forward PE, 27.78. Now, of course, with all the stocks that I talk about today, they can go lower. The S3 on Airbnb is below $100 at $93.09. These numbers are from a previous video, and you can see they've changed slightly. For example, the S1 is now $111. That was the S3 at $110.40. It bottomed in early August at $110.38. So it's trading about $4 or $5 higher than that price. I would love to see this stock $105 or less DCA. Of course, the lower the better, under $100. That would be great, and I would add more shares. I own this in the primary brokerage, that $2 million account, and I added some shares yesterday around this price. I believe this next stock will benefit from phase 2 of generative AI. So when you think of phase 1, it's going to be the stocks like Nvidia and Broadcom, AMD, and so on, the infrastructure stocks, right? You think of the databases that are being built out, that hardware, most of that's going to be phase 1. So other names like, for example, a Dell, an Oracle, and so on. Elastic is going to be that phase 2 generative AI, along with Palantir, MongoDB, and Snowflake. Now, MongoDB just had earnings here recently. It did very well. Elastic, the reason it sold off, the earnings were pretty good, but this is all about guidance again. I'm going to cover some of those fundamentals and some of those metrics as well as a chart, but I want to show you really quick on their website, multiple solutions, one powerful platform. So make the most of your data with Elasticsearch AI platform, integrated solutions, search, security, and observability. So you think about the GPUs being the engine behind generative AI. It really creates those LLMs. And what you need to do then is connect those LLMs to your data with an enterprise. So this is focused on generative AI for enterprise, for businesses. Companies like Elastic are going to help with this. Now that might take some time. So the growth might be a little bit muted in the meantime. This is a very long-term story. Again, like all stocks I'm covering on this video, 5 or more years unless the story changes. Now the earnings, like I said, were decent. Beat on the top and bottom lines, beat by 35 cents on the EPS. Revenue beat by $2.39 million. That's 18.1% year-over-year growth. The problem you can see right here, Elastic sees lower customer commitments impacting revenue. Stock slides 24% after hours. So essentially, this is about a warning, impact to revenue, and annual top-line guidance. This really comes down to a sales reorganization. Now, I worked in software sales, and I can tell you with confidence, anytime you make any changes to how salespeople are compensated, it's going to be a process. I do believe it'll work itself out. It's just going to take some time. It might take 2 or 3 quarters for this to work out. I like to look at the fundamentals of a company and buy when there's opportunity. When the market wants to throw it in the trash, that's when I generally like to buy against the grain. Now, this is going to be more of a hybrid. So it's going to have cloud, but it also has on-prem. It's going to be a little bit unique. So it's going to carry a little bit lower multiple when you look at the EV NTM revenue. Earlier, we looked at Zscaler. That's going to be closer to 10. But this year, Elastic, it was before this earnings call, it was trading at an 8 EV NTM revenue. It's now 4.97 EV NTM revenue. So a 4.97x, under a 5. Has 11% free cash flow. That rule of 40, you want it above 40. It is slightly lower, especially with the new metrics here. It's at 30. And the net dollar retention is pretty solid. It could be better. It's 110%. So I told the gang in Discord after earnings, so I've been waiting for this stock. I've been patiently waiting. I wanted $85 or less. Now, of course, the earnings report wasn't good and it brought it below 85. And I told the gang after earnings, my preference was below 75. It was hovering around $78. I said, there's a decent chance here it gets below $75. And that's my preference DCA. And you can see the S1 is 72.68. Now, these are updated Fibonacci pivot points. That S2 is 63.74. And this S3 is all the way down below $50 at $49.29. In November of 2023, this stock was below $70 a share. So it ripped from $69.66 up to $136 and all the way back down here. So it is possible that you could see this stock, under $70, especially because the S2, 63.74. This could easily break even $60 a share share. But looking at the valuation metrics and what it's worth, I believe 75 hours or less DCA, and the lower the better. If it goes to these lower numbers, I'll load up and go a little bit heavier. Keep in mind, you do have a gap down, and this could see more pressure, so it's not impossible to come down to these levels. This last one's more about a value play with a dividend. Hopefully it's not a value trap. Right now it's a 4P ratio of a 14, pays you a 2.82% dividend. Now Dollar General did miss on top and bottom lines and also lowered FY24 outlook. So this is a miss across the board, as well as lower guidance below on all metrics. Now, we never buy a stock based off of analyst price targets, but it's good to look at these. Morgan Stanley cut its price target on Dollar General to $100 a share. Another analyst cut from 168 to 103. So on tip ranks, it's showing a moderate buy. 35% upside, $108 is going to be the average price target. The highest is 170, which probably hasn't updated. The lowest is $90 a share. It's trading about $80 a share. Has pretty low growth, about 4%. In fact, the same sales stores growth was only 0.5%. Profitability wise, it is healthy. Of course, that gross profit margin is going to be lower as a discount retailer. It's profitable and it brings in about $7,600 per employee. This is net income per employee TTM. That valuation, the forward gap PE is about a 14. And the price to sales, the forward on this is only a 0.45. Now, of course, you want to look at dividend safety, because if the dividend is cut, the stock is going to get hammered. Dividend safety score in Seeking Alpha, a B-. So on a previous chart day several weeks ago, one of the members asked me to look at Dollar General. I said to be careful with this, study the fundamentals. I knew that DG was going through some issues. And you can see this stock is below the S1. That S2 is $70.17. And the S3 is all the way down here at $53.24. So this could see significant downside even from these prices. There's no guarantee it's going to happen, but it could come down, $55 or $50 a share. I'm buying this for my end game portfolio, close to 3% dividend. I have a very small position. I have 20 shares right now. If it gets down in these levels, I will add significantly more. If you're new here, make sure you subscribe to the channel. Click that bell for notifications. If this video is helpful, please smash the like button. Drop me a comment. I appreciate your time and attention. Have a great rest of your day. Take care.